Welcome to B2B Synergy, the Power Partners USA podcast, your exclusive guide to discovering the potential of B2B partnerships. I'm Alan Armijo, owner of Power Partners USA business-to-business introduction and referral service. Our members are B2B professionals who team up to provide each other repeat referral business or collaboration. Today's episode shines a light on Jim Better, owner of Essential Plans of Insurance. Jim has participated in 2 previous B2B Synergy podcast episodes. Jim actually is our very first B2B Synergy podcast interview, where we had a comprehensive discussion of long-term care insurance. Today, we're going to talk specifically about hybrid insurance plans available for long-term care expenses. So, Jim, how are you doing today?
I'm doing well, Alan. Thank you for the opportunity to be able to create this podcast with you.
Good. Welcome back. Let's get started. By definition, a hybrid has the qualities of 2 different things. Please give us an overview of hybrid long-term care insurance policies. Specifically, what is a hybrid long-term care policy?
In the early 2000s, state life insurance, also known as One America, patented a unique formula for their services to be covered for custodial care. They called it a hybrid policy because it covered 2 things. It was both a long-term care insurance coverage, and it also covered life insurance. There was a combination. The good thing about it is, unlike most of the insurance plans that we have, such as home or auto and so on, hybrid policies are guaranteed to pay off. That is, if you need long-term care or custodial services, it will cover those expenses. If you croak and never need custodial care, then it pays off like a life insurance policy. And for the life insurance companies that are in the business, and these contracts also build up cash value. So as they say in the promotion, whether you live, die, or quit, the policy is going to pay off.
So it sounds to me like this is a better option, because it sounds like other long-term care policies are just for the custodial, right?
Yeah, I bought my policy almost 30 years ago now. Well, and at the time, only the traditional contracts were available. And the traditional contracts do one thing. They just pay for custodial care. And if I were to do it over again, would I prefer to have a hybrid policy? I'm pretty sure I would take that because of the guaranteed nature of the payout.
So does that mean that if you buy any policy, you're locked in to that policy?
Well, yeah, anytime an applicant has a proof of coverage, they're going to proof of coverage on that day. If they say, well, okay, I'm going to start small and I'll need another one in 5 years, fine, but you'll have to pass medical evidence of insurability at that point. There's no increase in the coverage, with the exception of inflation. With the inflation rider, it increases both the benefit pool, such as $200,000, $300,000, and the monthly benefit, which might be, $5,000, $7,500, $10,000 a month. The inflation rider keeps those elements continue to increase to keep pace with the cost of medical care and custodial care as that increases every year. That might be 3%, 4%, 5%, depending on who you talk to.
Okay, so you really have to kind of know the outcome of what your policy does when you purchase it, because I've been paying more attention to in-home care and long-term care in the sense of people in an assisted living home. If they have it, it sounds like sometimes there's a daily max, so they might have to have some out of pocket. Is that true? So it sounds like you have to know what your policy is really going to do for you.
Back when 20 years ago, 10 years, 15 years ago, people were able to buy lifetime benefits because the insurance companies didn't know how to underwrite these contracts. They had no idea what a 10-year Parkinson's case would cost. So they covered lifetime coverage. But now that they have enough data, and of course we know insurance companies run on data, they realize, okay, we can't afford to cover a lifetime benefit unless we increase the price. So prices have gone up pretty substantially over the years because of the better underwriting.
Amount per day, like knowing what it's going to pay out.
Yeah. So today, whether you're looking at a traditional policy or a hybrid contract, you're really looking at, okay, how much can I afford to cover? Can I afford to cover 1 year of care or 2 years of care or 3 years of care? I mean, the crystal balls don't work and tell us how long we're going to need custodial care at home. So really, to keep contracts affordable, That's where the purchaser has to decide, okay, I've got enough money that I can afford to get 3 years of coverage. And if it goes beyond that, okay, then it's a crapshoot. Then maybe I look at Medi-Cal. Maybe the facility I'm in says, okay, you can stay here because you've been with us for 3 years or 4 years, whatever it may be. And so it's no longer a matter of buying a lifetime coverage. It's much like the reverse of a home or auto insurance policy, or even a health insurance policy, where you're purchasing an amount of coverage and you pay the deductible. If you've got a health insurance plan, you pay the $5,000 deductible, then the insurance company kicks in. Or your auto insurance, maybe you've got a $1,500 deductible, you pay the first $1,500. Long-term care flips it. The insurance company is going to pay the first $100,000, $200,000, $300,000. And then after that, then you're kind of on your own, or either out of pocket, family services, or government services.
So in terms of hybrid, all that applies, I assume, but you also have can you explain the other elements of a hybrid?
Well, the hybrid, one of the important parts, and it's one of the questions that you had as well, is the tax benefits of these contracts. In 1989, when the National Association of Insurance Commissioners got together and said, hey, look, this industry is out of control. They're writing these contracts that are so rich, and the insurance companies are going to go broke. And so they said, okay, we're going to create tax qualified plans. And tax qualified means that all benefits that are paid out for a long-term care or custodial care contracts. See, I keep doing long-term care too. I'm trying to get myself conditioned to call it what it really is. But the tax qualified plans say that the benefits that are paid out are tax-free. And because the government is concerned about people taking care of themselves, there are elements where the premiums are tax deductible. Now, one thing that I stress to my clients is that when you have a hybrid policy and the benefits are going to be tax deductible and the premiums are tax deductible, but only for the portion of the hybrid policy that deals with long-term care or for custodial care.
And not the life insurance part?
Not the life insurance part. Okay, that's not tax deductible. The younger people are, the lower the cost of the life insurance component on the custodial care policy. The older people are, the life insurance cost is higher. So the tax deductibility is lower, comparatively speaking, between a 70-year-old and a 50-year-old. But even accountants, the ones I've spoken to, need to be reminded that when people take a tax deduction for their long-term care expense policy, that only the portion that relates to custodial care is deductible, not the life insurance part.
So just to rehash here, the summary of a hybrid policy is the component of two things, and it's the custodial part and the life insurance part.
Right. Those are the two important elements.
Okay. And it's tax deductible.
When I say tax deductible, I mean, if an individual is purchasing a contract for themselves and their spouse, the cost of the premium has to exceed the 7.5% medical deduction on the 1040. Anything over that is tax deductible. Anything below that, and the tax deductibility includes the premiums that you pay for health insurance, deductibles you pay for health insurance, premiums on a custodial care policy. Those all add into the 7.5%.
What product is that? Is that all of them, or?
That's all of them. And you get a deduction on your 1040 for your expenses for health insurance and for out-of-pocket expenses. And you can add in the premiums for a long-term care policy.
Okay, but business using this, you're saying it's deductible, but after 7.5%, even for businesses?
No, not for businesses, just for individuals.
Okay.
If people purchase it on their own, then it's 7.5% applies. If a business applies for it, whether it's S Corp, LLC, partnership, the owners of the company can deduct the premium for themselves and their spouses, insofar as it's a hybrid policy, the custodial care part. And C corporations allow that deductibility to apply to anybody in the company or everybody in the company. What we see is the companies that are structured as a C corporation have a unique advantage that they can deduct the premiums for the custodial part of a hybrid policy for themselves, their spouses, and all of their employees. So it's a unique advantage for C corporations.
You have clients, like corporate clients, that are doing that?
Yes, and most often what they do is they've got, the president, the vice president, the treasurer, maybe a few other people in the high-end, high-priced help that they award and use it as a part of the golden handcuffs to maintain those, keep those employees on by purchasing the premiums for the policies for those employees. Not for everybody. They could, but
Can
more
employees
risky.
can the employees take it with them if they leave, or is that with the company?
No, these are all written as individual policies, so that if the employee leaves, they can take it with them and assume the premiums on their own.
Right, right. So when you sit down with clients and you talk to them about any of the policies, is it pretty extensive interview just to kind of, beyond the medical part, just I'm talking about like the amount that the policy is going to pay out, when it pays out. You have to make that crystal clear to people.
Yes, I mean, when we do the annual review, we have to keep reminding them, because when people walk away 3 months later and say, "Hey, I've got a long-term care policy." Well, what's in it? Well, I don't really remember, but I've got one, and it's a beauty. Oh, my guy said it's a good one. And so I believe. So every year we have to go through it and say, okay, your total benefit, your total coverage for this custodial part of this policy now is $300,000. And the insurance company will cover those expenses up to $5,000 a month or $7,500 or whatever the original contract was.
Okay. All right. Anything else we need to cover as far as hybrid policies?
Yeah, there's some interesting developments. We live in a world in this country still, where competition matters. And we're seeing insurance companies becoming more competitive and developing some unique features. For example, Nationwide, the first of this year, rolled out a product where they're going to pay the expenses on a cash basis. If you have a custodial care nurse come in and say, help you with the activities of daily living, you can pay them out of pocket, because the insurance company is going to send you that $5,000 check or that $7,500 check every month, as long as you still qualify as needing the services. And so it's a cash basis. And that's important, because in the beginning of a long-term care event, there's a lot of nickel dime expenses. I need some more drugs. Somebody's got to get some food. There's a lot of small expenses, because people don't go from happy, healthy to nursing home. People want to stay at home, and it's a set of conditions that gradually take hold and diminish the capacity for people to be able to function with their basic activities of daily living. So being able to have that cash up front is important to people at the beginning of a custodial care event. Another company, One America, for example, has recently rolled out, like last month, a 0-day wait for home care. Now, what that means is that all these insurance policies say that there's a waiting period before the insurance company will begin to cover expenses. Maybe it's 30 days, maybe it's 60, maybe it's 90. Most often it's 90. And that's really an old underwriting metric they use. But that first 90 days for those contracts can get expensive. And what America has come out and said, look, if you're at home, there's no cost for waiting period. We'll cover those expenses from day one for home care. And once you reach the regular waiting period time of 90 days or 60, whatever it is was in the contract, then it will begin to cover facility care. It doesn't cover facility care in the beginning. What it does cover, which is a real advantage to people, is that there's no waiting period before they'll cover expenses for home care. And we know everybody wants to be at home and be in comfortable surroundings. They want to be with people that they know. They want everything to stay the same so they can deal with whatever their disability is. These are the two latest developments this year. What's going to come down the road? One America may say, okay, look, we won't make this a reimbursement expense. We'll make it a cash expense. So they just send the money out, the monthly benefit out, so that those early expenses can be covered on an immediate basis and not have to wait. One of the provisos with the cash policies is that the IRS is going to tax the income from that over and above a basic amount of $420 per day. If a policyholder has home expenses or facility care expenses that exceed $420 a day, then that amount is going to be taxable what's beyond the $420.
So that's it for hybrid policies, right?
Yeah. And, but one of the overriding factors, what drives people to invest in these types of contracts, generally it's two things. One, people will recognize that this is a very expensive part of life because they're sandwich generation people. They got a parent, they're putting into care, and they have their own children. And they realize what a burden it is financially, so they want to take care of business, and they become motivated to purchase a long-term care policy. And the other is the state preservation. People save money. You got 401ks, you got IRAs, you got other investments, CDs, who knows? You got all this stuff. You got these little pockets of money that you're building up. You're not saving that money because I want to be able to pay my nursing home care. This money is got a specific purpose. Maybe it's to help the children out. Maybe it's to give the grandchildren. Maybe to take a lavish vacation. Who knows what it is? But the money isn't being saved to pay for long-term care expenses or custodial care or any of those things. It's got other purposes. So what these contracts do, it frees up that money. It says, okay, you don't have to worry about saving $300,000 at your nest egg to cover long-term care expenses. The insurance policy is going to take care of that.
Sure. That's great. Great. Thanks for covering those two reasons why it's important to have this custodial care. Let's talk about, how you do business in the sense of, the more I learn about this, the more I talk to other people. I said, like, the financial advisors say, well, we sell long-term care insurance. And I'm like, why is it financial? I see why financial advisors is selling it, because of the last reason you gave was the estate protection, right? Having the money there. You more on the insurance side, you sell other insurances versus like financial planning. So like, I would think, are you seeing that financial advisors are as well versed on it as you?
But I'm going to give you a straight answer on that. I don't know how they can keep up with the changes that have taken place in the industry if they've got two other things that they're doing at the same time. If you don't like what I got in this pocket, I got something in this pocket. We made a decision a long time ago that this is such an important element to people that we were going to specialize in it to be a valuable service to our clients and to their families. Because it's a family matter. When you think about it, when an older person needs home care or needs to go to assisted living, that's a crisis. The families are disrupted. And the families in the beginning want to jump in, they want to take care and they want to help out. But that gets old because they have the lives of their own to lead. And what these insurance policies are designed to do is to mute the disruption that a custodial care event creates by providing the money for it. It's an emotional issue. It always will be, but it doesn't have to be a financial disaster.
Okay. So, in our updates and our news, I've been working with Arlene Moran, who owns Option One Care, who provides in-home care services. So I'm learning more of the ins and outs of, what assisted living facilities do, skilled nursing facilities, and the need for, people helping people stay in their home. But in terms of, she obviously takes that insurance, but who, I think, in those situations, that's not your client. That's not the referral because they already need the service. They're not going to be able to get it. Would it mean that the referral would come from, say, the children, like you said, the sandwich, seeing that, to avoid these extensive costs that they may or may not be able to pay at this point, do they have that? Is that kind of the best referral for you?
Yes, those are the people who are most likely to want to engage in the conversation. There are other people, other categories, if you will, and they pigeonhole people, but single parents are another group of people that are more interested in engaging in the conversation than maybe some others because they don't want to become a burden to their children. Another category, if you will, of people that are interested in the conversation are couples that have a big age difference, a 6 or 8 or 10-year age difference. Normally, we know that's the guy is older than the woman. Statistically, he's going to need long-term care, custodial care, long before his wife. And if he needs it and doesn't have the protection, he could use up all the money in his care. So by having a long-term care policy in place, It goes back to the preservation of the assets that are in place for the usage of the surviving custodial partner,
So
community
what
partner.
in running these circles in skilled nursing facilities and having lunch with case managers and stuff like that, are they would know the status of the families, right? Like, do you get referrals that way?
Yes, it comes from many sources. Estate planning attorneys are a good resource. People who are in the caregiving business, companies like Visiting Angels and Home Instead, those organizations are a good source of referrals as well. And, somebody says, well, who is a good prospect? The reality is anybody who can fog a mirror is a prospect. Now, that said, you don't sell these things over the counter. People have to qualify for them. They have to qualify for them medically. And our practice has always been, instead of wasting people's time by looking at numbers and what's affordable and how much, what's my total benefit and monthly, what's my inflation, we look at, okay, what kind of medical information do we need to get a pre-approval on before we even apply for coverage? And that's important, especially for people who are not yet retired, is that if you apply for an insurance policy and you get declined, that becomes a red flag in your medical records. And if down the road you want to do another financial transaction, that's going to pop up as a red flag. So we do the best we can to pre-qualify people by gathering as much medical information as possible and have the insurance company say, yes, this is a risk that we're willing to accept. And by doing that, we avoid the likelihood of it ending up being a red flag in the Medical Information Bureau.
Okay. All right. Is there anything else that you'd like to add before we close out?
Well, the only thing that I would like to add is that people are reluctant to admit that they may get old and may need home care or assisted living or long-term care. I'm willing to say, okay, well, we'll just wait and see what happens. The people that I'm most interested in talking to, they'll say, yes, I recognize the problem and I want to find a solution.
Okay. Well, it's good to know that. Keep my ears open for those conversations or prospects for you. At the same time, if you know anybody that needs in-home care services, just give me a call. I've been working closely with Arlene in that area. On top of that, I want to let everybody know that our show notes will have links to Jim's previous 2 interviews where we talk, in total about long-term care and its relationship also to estate planning. So Jim, thank you for your time today. It was a great conversation. Thank you for your time in Power Partners, and we look forward to continue collaboration with you.
Thank you, Alan. Me too. We'll
Thank
talk
you.
soon.
Okay.
Bye-bye.